Howdy, Jacob here. Today we're looking at Manhattan Associates, company 63 in our high ROIC screener. Market cap of 15.4 billion, enterprise value a little bit lower. Growth looks pretty substantial, over doubling, almost over doubling. Um, I guess just almost doubling over the last 10 years. Pretty volatile returns on their revenue. So we see that as high as mid double digits, but then a couple years of negative growth. Last 3 years have looked absolutely astounding. Return on invested capital, amazing. Gross margin actually down a little bit, and same with operating margins. So that's not connected to, um, when you see a moat, you see increasing margins, increasing return on invested capital, meaning that although the business is increasing revenues at X percent, their margins and earnings are increasing at X plus something percent. Where earnings and cash flow are increasing more than revenue is kind of just one of a possibility of reasons to see a possible moat, which we see declining margins. So not necessarily a turnoff, but just definitely something to point out there. 271 million cash on hand with zero long-term and short-term liabilities. Very safe balance sheet. Cash flow perspective, the capital expenditures are zero, essentially. I mean, it costs nothing to keep this business running and afloat. They're gushing out cash flow. I love that. Absolutely love it. And it looks like everything they make, they are spending on buying back shares. So that's interesting. It looks like their use of cash is increasing their cash on their balance sheet and buying back shares. There's really no reinvestment, really no acquisitions that it looks like. So definitely going to keep that in mind when we're doing our assumptions here. So on the revenue growth side, I think that might slow down. I think those last 3 years are pretty immense growth. Maybe we'll see 8% and then 17 on the P and price to free cash flow, as they're really not reinvesting at these rates of return. So if they were to be reinvesting their money and possibly getting 40-50% on those returns, you obviously want a larger terminal P and price to free cash flow based on their ability to possibly give you extra returns. But here we're not seeing that in the fact that they're spending everything on repurchasing shares, which isn't necessarily investing at those rates of returns, as it's buying back shares that are, every investment's present value future cash flow. So it's just depending on whether they're buying back cheap shares or not to give you a good return. So that's the reason my P is there, because I do think that there's growth in excess of the market, but I'm not inflating their P and price to free cash flow due to higher ROIC just because they're not reinvesting at those rates. So margins, their free cash flow margin is a lot higher than their earnings margin. I love that. Let's do 24% minus 1% of shares a year. And that gets us to a price point that's just a bit expensive, which again, we can see through them having an 80 PE, their growth not outsubstantiating my discount rate. And we're deflating the PE to 17, which I think is reasonable at the end of 7 years. I don't think that their growth and moat and higher ROIC really make up for that crazy of a P and price free cash flow. Personally, obviously, to each their own. Do your own analysis, come up with figures that make sense to you. But for me, I balance out growth with what return are they going to give me with consistency. There's a lot of art in investing, and that's your terminal price to earning and free cash flow are definitely part of that art. So just hope you enjoyed the video and have a great rest of your day. Thank you.